Hello there folks, welcome into the three-piece, 3 videos for me to react to in this one here today. First one up here, ooh, this one may be a little bearish, looking forward to getting in this one. Beartaras! Dan Morehead explains why he believes equities, a la stocks, are wildly overvalued. We'll get into that one, can't wait to react to that, kind of give my opinions and perspectives there. Then Mr. Josh Brown, I haven't seen him as much this year. I don't know if he's been in hiding or what's going on, but Josh Brown says major indexes could hit 2023 lows if jobs data comes in hot. Wow, okay, yeah, good news, bad news, I guess, right? And then last video up here from this gentleman that looks like somebody just called his mama a name, the case for a November rate increase is going down, he says. I want to react to that one, give my opinions and perspective. So appreciate everybody being here as always. Thank you so much, folks. We are now over 35,000 subscribers on the channel. I appreciate every single person subscribed to the channel. Thank you for being here as always, and let's jump into this.
16-year highs yesterday. Our next guest says the yield on the 10-year could hit 5%. Join us right now to talk about that, and of course cryptocurrencies. Dan Morehead is the founder and managing partner of crypto hedge fund Pantera Capital. Dan was formerly the CFO and head of macro trading at Tiger Management. Good morning.
Thanks.
Okay, so let's talk crypto in just a second, but let's talk about bonds, because it very well may be that the bond market will have an impact, I imagine, on crypto. But where do you really think we're headed, and what does this next 12 months look like to you, given what we've even seen in the last week?
Yeah, I think we have a failure of imagination that all working age people have never traded in a rising rate environment. I came to Wall Street in the 80s, and it was already 6 years into a 40-year bull market, and everything gets bailed out by the Fed lowering rates for the last 40 years. We're in a different regime. And the rates, 2 years ago, I predicted when Fed funds were 0 and the 10-year was 1.3, they both go to 5 at least. We're here. I think they're going higher. The normal real rate for the Fed is 1% over inflation. We're not even there yet.
Right.
Wage inflation is double the Fed's target. We have record labor strikes going on right now. So the Fed has to keep doing more. And the 10-year note is right now we're flat to Fed funds. It's typically a premium. It's typically a 2% above inflation.
Earlier today, we had a guy on from Bob Michael said that inflation's, what are you saying inflation is now? What number are you using?
Well, so core inflation is 4.4, which is more than double the stable prices that the Fed uses.
He said inflation's already at a point where rates are too high. That's what he was saying.
Oh, inflation, they're supposed to keep it under 2%, and it's at 4.4, and wage inflation is 4.5 and increasing.
Right. The question is, when you have, like a Barry Sterling will tell you that, like, what he would call real inflation, he would think is when you really calculate the full thing, he would say we're already there.
Yeah, so this gentleman, okay, hold your horses for just a moment, right? That's a really scary, oh my gosh, he scared us there, right? Oh, we need to go a lot higher, we're not even close, right? We're on the come down. Let's just call it what it is. We're on the come down right now, okay? If I listen to, I guarantee you, more conference calls than that gentleman, or probably, certainly anybody watching this video right now, there's no one that listens to more. I'd probably listen to more conference calls than anybody on Wall Street, by far, and it's not even close. I'd probably listen to easily 50 to 100 conference calls every earnings season. 50 to 100. I don't think there's anybody else touching those sorts of numbers. And I listen to conference calls across so many different industries because I own so many different stocks. I'm keeping track of so many stocks. I listen to restaurants. I listen to hotels. I listen to everybody, okay? Wages is really the only thing we're having a little trouble with right now, okay? As far as anything outside of wages, you don't really have any trouble there, right? You can say, well, gas prices are gas prices come and go, okay? 1 minute gas prices are high. Gas prices are always high. Oil price, we should say, okay? Oil price, 1 minute's high, all of a sudden some bearishness happens. Next thing you know, oil price is tanking and a barrel of oil is 60, 70 bucks, right? They'll still keep the price high at the gas stations. Believe me on that. Don't expect to get some big reprieve. It's kind of a ripoff nowadays, but that's a subject for another story in regards to that, right? Remember when you used to pay, in 2007, 2008, $4 a gallon was like the price, and oil was $140 a barrel back then. Now you pay $4 plus at the pump, and you can have oil at 70, 80 bucks. Okay, it's a whole different game, but once again, that's a subject for another day, right? So wages is really one of the only areas we're really still having a lot of trouble, and wages are really just playing a game of catch up because everybody got sliced and diced by the price is going up so much. If you talk about transportation costs, it's gone down immensely. If you talk about home prices, they've been doing a whole lot of nothing, and people are taking their homes off the market because they can't move them. And so you still have sellers that are ultimately, let's just call it fairly stubborn now at this point in time. Rents are getting much harder. If you are a landlord out there, you know exactly what I'm talking about. It's getting much more difficult. If anything, I've had to drop rents on a couple of my properties versus raising rents, okay? And those are in two markets where people are moving to and in the best areas of, you could possibly think of in regards to those particular properties. Those are really good areas. And so, he's just not in reality land. He's playing a backwards game now at this point in time. So if I look forward to 2024, I see wages being a little bit of trouble, but that's only if the employment market stays extremely strong. If we see a little bit of weakness in the employment market, then you'll actually see wages weaken as well, which then you got nothing as far as inflation goes. So he's just playing a backwards game. Fed's at 5+%, and they're catching up, and they're hitting us. Well, if we really got all that inflation going on, right, then why can't you sell a house right now? If inflation's, why we got the worst real estate market in history, right? If inflation's really so high, why are car dealerships having to now drop prices substantially? If we have high inflation, why is Tesla, the company that has more demand for their products probably than any company in the world, why are they having to drop price right now, right? Why are companies' margins getting squeezed? Well, because they're not being able to raise price, right? So if you were in a high inflationary environment, companies would be raising price. You'd be seeing Tesla raising their Model 3 prices, raising the Model Y prices. You'd see all these companies raising. These companies can't do it anymore now at this point in time, okay? Which goes back to the, inflation is just going to be dying down in a major way. And I think it's going to be even a non-subject in 2024. So this man's just looking at backwards looking data, no different than the Federal Reserve is looking at backwards looking data, which just goes into why they make such bad decisions.
The question is whether you think the Fed either thinks we're already there or you even think that's real.
Already at 2%?
Yeah.
So the funny thing is there's an owner's equivalent rent thing in inflation, and it takes 2 years to fully play through. And even if houses stayed stable for the next 2 years, it'll still go up 1.1%, according to the Atlanta Fed. So there's still a lot more inflation from 2 years ago that's piped in. And the Case-Shiller home index is still at record highs.
So if you're right, we're talking about increased rates, nobody lowering rates in the next 12 months.
Yeah. And maybe for several years, right? Like, I think that's what people are having a hard time thinking about, is rates could stay up for 5 or 4 years.
If that's true, then equities are wildly overvalued.
That's true.
That's true.
It is true.
Okay.
You would think Bitcoin would be...
But then I would think that crypto would be wildly overvalued too.
Yeah.
So equities probably are overvalued because the PE is the same level it was when rates were crashing, but now rates are much higher. And if you took the normal equity risk premium for equities onto a 5% 10-year note, they should be 23% lower than today.
Wait, equities should be 23% lower today?
And
You're talking about the S&P?
The S&P, yeah. And if you took it compared to its 50-year average of equity risk premium, it'd be 43% lower. And I'm not saying 43 is going to happen, but we got to keep in mind, there have been 2 13-year periods that equities didn't go up in the 2000s and in the 70s, 80s. We could see that.
You think 23% is going to happen, if not 43?
I think equities are going to go down for the next few years. And that's why crypto is relevant, because it's not tied to interest rates. And that's pretty rare, right?
But it kind of is tied to risk.
What? Are you kidding me? How much is Bitcoin off the peak? 60%? 65%? Something like that? Come on, man. What are we talking about here? Like, literally since the Fed started raising rates, look at how much Bitcoin's fallen. Come on, man.
You need the Fed opening the spigots for Bitcoin to go up.
Well, the Fed opening the spigots in 2020 was unambiguously wonderful for anything that had a fixed quantity.
It hasn't been an inflation hedge.
Yeah, so the thought is it was highly correlated last year. And
what?
So Bitcoin is a proxy
Like
for
risk on. NASDAQ is what it's
risk on.
Yeah, so it was a very risk-on asset until the middle of last year, but I think that was correlated with or connected to a lot of super highly levered things like BlockFi, Celsius, FTX, and those are once in a generation weird occurrence. They're in the past, and this year the correlation of Bitcoin to the S&P 500 is only 0.2. Historically, it's 0.1.
What? Damn it, dude. Are you serious right now? You don't compare Bitcoin to the S&P 500. It's compared to the NASDAQ, okay? It's a play on the NASDAQ. It's a play on NVIDIA and AMD and the high-tech stocks and the major. Look at how much NVIDIA is up this year, right? Look at how much AMD is up this year. Look at how much Meta is up this year. Look at how much all those tech stocks are up. Look at how much Tesla's up this year, right? So that's more of what it gets grouped into. When those stocks are roaring, Bitcoin's usually roaring. And when those stocks are getting destroyed, as what happened last year, look what happened to the price of Bitcoin. And remember, in regards to that whole Bitcoin situation, remember, we don't even know how far Bitcoin could have fell because of all those companies that went belly up, right? People couldn't even get access to sell their Bitcoin during that time period. So we don't know what Bitcoin really would have fallen to if it wasn't for all those brokerages and exchanges going under last year, right? Because that just caused a freeze on everybody's assets. Think about that for a moment, right? We'll never know. So, yeah, what are we talking about here, man? Holy smokes.
So what is it correlated to then?
So it's like, some people call it digital gold because it's kind of its own thing. It's not interest rate related. Obviously, bonds are interest rate related mathematically, equities, real estate.
I think people are waiting for a cut. And every time they think there might be a cut and the Fed starts easing again, that's when Bitcoin goes.
If the NASDAQ tanks 20%, Bitcoin's going to tank 30, 40, 50%.
As its fiat becomes less valuable.
I agree. It is definitely cyclically connected to things like that.
Okay.
But my overall view is we're in a 20-year secular bull market in blockchain, right? It's a very transformative technology. It's going to change so many different things. And so, yeah, it does squiggle a little bit with what the Fed does.
There's crypto.
Yeah.
There's some people today who would say there's crypto and then there's Bitcoin, right?
Yeah.
And that they should actually be completely separated. We shouldn't even have them on the same screen together.
Yeah.
Do you believe that?
Well, so Bitcoin is the first brand of blockchain. There's Ethereum and other brands of blockchain. Bitcoin has worked for 14 years, 24/7, no downtime. It's amazing. Like Facebook goes down, everybody else, we just heard about Clorox getting hacked. Like, Bitcoin's always worked, so it's great. It has about 50% of the entire market cap. But the other cryptos are very important. There's a project called Arbitrum that's helping scale other cryptos. Ethereum's worked really well. They did a merge last year.
All right, that's about enough of that. Mr. Pantera Capital, I need to go listen to some Pantera after watching that. All right, next one up here. Major indexes could hit new 2023 lows if data comes in hot, says Josh Brown.
Here to get ahead of all of that. Joining me for the hour, everyone at Post 9, Josh Brown, Kerry Firestone, Jim Leventhal. Take you 12 noon in the East. We'll show you what the markets are doing today. Red across the board, as you see. Red 2 from yields, which we continue to watch closely. 472 is the note on the 10-year. So you, Josh, are real dialed in on tomorrow and the jobs report and what might happen to this market depending on what that print is.
Yeah, I'm usually the guy that comes on and says, ignore the economic data, it's already priced in. I think in this case, if we get a hot jobs report that contradicts the little bit of relief that we got from ADP in the middle of this week, I think that you're going to make new year lows in all the major indices. I really don't think there's any way around it. I really think it's if this, then that, and it's as simple as that. I wish it weren't so.
Okay, before he goes any further here, okay. I'll be honest with you guys. I think that's a potential. I think that's a realistic potential what Josh Brown brings up there, okay? I don't know about the NASDAQ new lows, but as far as Russell, Dow, and SP 500, I think it's very much a potential. We're in that kind of time of the year where people are kind of looking to cash some stocks, to tax loss harvest, to do whatever they want to do, right? And make those sorts of moves. So I think what Josh Brown brings up there is definitely realistic, and I think a lot of people are just like, give me something a little more to make me want to sell, and on Wall Street. So I think that's realistic.
I wish people weren't reacting that furiously to a monthly look at whether or not we add 80 or 90,000 jobs in an economy where 150 million people are working. But absolutely, the markets are going to be quick on the trigger. A lot of this stuff is algorithmic anyway. Doesn't even require the sentience of a human being until later on. And I think that probably dictates the next 1,000 points in the Dow. So, and what it does beyond there, I don't know. The good news is economists are looking for about 170,000 jobs.
Hey, Josh Brown, you're preaching the choir, man. That is the good news. Let's get this S-Dow to skyrocket over this next couple weeks. Come on, baby. Come on, S-Dow.
In fact, we come anywhere near that number, that would be below the 187 that we added in August. And I think it's doable. And I think in large part we might be helped out by the auto strikes. This might not show up in this month. Maybe that's in next month. Revisions downward would be helpful as well. The Fed, I think, is miscalculating by continuing to pound on this higher for longer, higher for longer, higher for longer. What they've basically set up is a scenario where every uptick in the 10-year Treasury means like another $1 trillion coming out of the stock market. It's really stupid messaging. I think they could calm it down a little bit. They have largely gotten their way all over the economy. And so if we get this cooled off jobs report, I think it will really help sentiment. And it's possible stocks might have seen the lows for the year if that's what we get. Keep in mind, we are...
Wait, before he goes further, because he's just rattling off a lot of stuff here. The Fed's paranoid. The Fed is scared. We know Jay Powell's scared. He's scared of the 1970s, right? He's scared of inflation coming back. And so they want to keep talking tough. They want to kill inflation down until it's obvious it's dead, right? Where right now you still got talk of wage, increases in wage pressures and things like that. We need to get everything done, right? And so that's the way Fed's looking like, we've come this far, let's not let it go. Let's make sure we finish the job. And so that's my opinion on why they're still talking so tough. Do they really believe it? I don't know. I don't know. But the bottom line is they need to finish the job, right?
Very washed out. I talk about internals all the time. I want to relay to you that the RSI on the index itself, on the S&P 500, the RSI is now 32. 30 is the low for the year, which happened last week. We are now more washed out, though, last week and this week than we were during the SVB crisis when the RSI and the SPX got to about as low as 33. Are we in worse condition economically now than we were when we thought there was going to be a mass bank failure? It seems so overdone. So the fuel is there for a bounce if we get what I hope we get.
The problem, Kerry, is you got people like BTIG's Jonathan Krinsky saying 4,200. We're, 70 points or so above that. It's not going to be the low. That too many people expect it to hold, and then you get a nice rally into the rest of the fourth quarter. But he says may not be the case. Chris Ferrone, Strategis, says yesterday's rally hardly gives you the all clear. You didn't even get 2-to-1 advancers to decliners. The internals are weak. Barclays, we believe we have substantial room to reprice lower before bonds stabilize. That's where the narrative is now. You could say, okay, well, now everybody's getting negative, so maybe that's a positive.
Well, I think what you're hearing are the people who have been negative all along are really raising their voices.
Boom! Exactly. That's what happens. You get the market to start going down, and the bears come out of the caves, and then they all start shouting from, the hilltops. This is going on. So it just gives them some more, let's call it some more wiggle room to just come out here and talk about their bear cases again and again and again. So they've kind of been in hibernation a little bit, especially, as we went into springtime and summertime.
People who have been bullish are very quiet right now because the last couple of weeks are not playing into anything that's optimistic. I think we have to see what comes out of those job numbers. And the job numbers that we saw from ADP were lower. We know, by the way, Josh said this could be lows for the year. We could see the market come down some, but think about what's happened to inflation through the course of this year. It's continued to go lower, and it's still going lower. We had this spike in energy. Now we have less demand, it appears, and energy prices are coming down. So I think the number can well be within a range that the market will be comfortable. This has been a hiatus period. It's fine. We understand that. And frankly, I think it's time to sort of let the Fed see what the numbers are.
I'm hurrying you along because I have some news that I want to get to. And I just
Firestone brought up some great points. I like her.
Hold it any longer because it is causing shares of General Motors to take a big drop. Take a look at GM shares as we speak, which I saw down about 3% intraday. There's a Wall Street Journal piece out. There you go. There's the big drop, and it coincides with this story, according to the Journal, that General Motors has at least 20 million vehicles with potentially explosive airbag parts. Again, that's according to the Journal, which also says that NHTSA, the National Highway Transportation Safety Administration, is holding a meeting right now to consider whether to order a recall over those airbag components.
What a mess, okay? And that's why for Tesla, those are things you always got to worry about as the fleet gets bigger, right? A great thing for Tesla is, one, their engineers are freaking amazing. Two, they usually do things so much more in such a simple manner compared to almost all other automakers across the board. So hopefully, when we have 10, 20, 30 million cars in the US, let's say, that are Teslas, hopefully we don't run into those sorts of issues. Those are very, very costly issues, okay? Before we get in this last one, folks, make sure you join me on Patreon. That's my pinned comment down there. I have 2 different tiers. One, you get to see access to all the moves I make in the Patreon portfolio, which now it's up to $6,000 in there, and I'm making moves in there tomorrow. And so it's a phenomenal way to see exactly how I build a portfolio. I'm going to scale that to $10,000, $25,000, $50,000. Imagine if you got to see the public count the whole way it was being built, right? Which I built that over the past 6 years, and now that's $1.7 million portfolio, right? So yeah, it's definitely very valuable to see exactly how I build a portfolio. I have another tier as well in there that comes with a very nice course for you guys that kind of teach you a lot. So yeah, if you want access to that, check out the pinned comment down there. Alrighty guys, let's get into this last one. The case for November rate hike increase is going down.
Chief economics correspondent at the Wall Street Journal. His latest article is titled Bond Sell-Off Threatens Hopes for the Economy's Soft Landing. Also, Brenda Vignello, who is Chief Investment Officer at Sandhill Global Advisors. Welcome to both of you. Nick, let's start talking about what's happening with this rise we've seen in interest rates. There's been a lot of speculation lately, including an article from Kevin Warsh today in the Wall Street Journal, an op-ed that suggests things have really become unhinged and the Fed is not controlling it at this point. It's bond market investors who are doing that. What do you think?
Yeah, no, Kevin raises a fair point. I mean, this looks like you've had a rise or a shock here in term premium, and it's not clear what the Fed can really do at this point if that's what is driving this. By one hand, this is what the Fed has been wanting to see all year, tighter financial conditions, but it's a little bit, Becky, like hitting that glass ketchup bottle. You keep hitting it, nothing comes out, and then everything comes out all at once. And at some point, exactly, all over the time, and you're not sure, at what point is the Fed going to say, okay, this is enough tightening in financial conditions? So I'm with Steve Leisman in the last segment.
You guys ever use one of those ketchup glass bottles? The stupidest thing, man. Holy smokes. Like, I'm glad they came up with the plastic bottle squeeze design over time. Oh, it's so funny.
Expect to hear, an immediate change anytime soon. You're going to have to see the data weaken or some kind of market accident to get this to stop. If this was Fed-driven, then, Fed words could change it. But I don't see why they would step in here at this point.
Would they step in, or I guess does it at least mean that they're not going to hike rates again? They don't have to do that because the work's already been done?
That's just it. So, the case for a November rate increase is going down because you've gone up 50 basis points in the 10-year Treasury in the last month. You've gone up almost a point since the last rate increase in July. And so the case for raising rates in November, it already seemed pretty weak. I mean, Powell at the last press conference 2 weeks ago saying proceed carefully 6 times. And December's still a long time away. There's still more data to come out. But if we sustain these tighter financial conditions, then the market is finally doing the work of the Fed. And so it means the Fed doesn't have to do as much.
Yep.
Hey, Brenda, we watch every time interest rate yields go up, you can see the inverse reaction for the equities. Right now, Dow futures are indicated off by about 130. Is this simply the idea that, look, the stock market looks less attractive if you can get a much higher yield on a longer term investment?
I think it's that, and I also think it's what Nick was just alluding to, and that is that with interest rates higher, that puts more pressure on the economy potentially. So there is a risk that we do see more of an economic slowdown happening. Certainly not seeing it in the current moment, but that's certainly a possibility. But I would say, when you look at how you're going to allocate assets, when suddenly you can lock in yields of around 5% on the 10-year, which thankfully would come down a little bit versus where we were at a few days ago. But that creates competition, especially when you look at an individual investor in a high tax state. You can buy a treasury bond, it's tax advantaged, and lock that yield in for a long time. And if inflation continues coming down, that real yield just increases. So I absolutely think that it creates more competition in terms of assets, trying to find a home that will deliver a decent return and who can argue with a risk-free return.
That's right.
Nick, how does the Fed look at this? Are they relieved that the market is kind of doing its work for it? Or?
Yes, 100%. 100%, Becky Quick. Yes, they are very relieved that, let's just call it treasuries, are doing their work for them, yes.
Are they worried because they've kind of lost control?
Well, that's a great question, Becky. You know, I think the Fed prefers to see things unfold orderly. And obviously, you know, market conditions, the traders I talk to say that, you know, conditions are orderly. This sell-off has been happening in an orderly manner, but it's rapid, right? And so, you know, the Fed, before the next meeting, they're going to get another economic forecast from the staff. It's in the Teal book. And if you go back and look at 2013, July of 2013, when we had just had the taper tantrum, they're going to get a set of projections about what this increase in yields, if it's sustained, if you have a higher positive term premium, what is that going to do to inflation? What is that going to do to unemployment? What is that going to do to growth? That's going to have an effect. And so they have to worry at some point about getting more than they bargained for. And I'm not suggesting that we're there yet, but you don't want to see things happen just kind of snap of your hands. You'd rather see it happen over maybe a little bit longer period of time.
Yeah, so let me play out the jobs market here. Obviously, we know the jobs market's likely going to be very good for this next few months, right? We're about to go into holiday shopping season and holiday spending season, which is great for the employment market, right? But I do think there's a potential you could see some real weakness in the employment market. Let's call it in the front half, the first 6 months of 2024. It's definitely a potential that you could start to see some real weakness there. So that would be the moment that everybody gives up on the inflation case. And then the conversation then will move to, oh boy, how long until the Fed starts cutting rates? Because if you were to see actually some weakness start to come in the employment market in that first half of 24, everybody's going to start saying, okay, inflation is not a problem anymore. What are we doing about rates? Because rates are really high. We're starting to see some real weakness. How long until all of a sudden we start seeing big job losses, right? And the Fed goes way too far. And next thing you know, they go so far that they're having to bail out the economy. They're having to do quantitative easing, put rates back down to zero. Is it a healthy thing? No. Okay, so they're going to have to try to get this thing perfect, where at some point they start dropping rates, and they drop rates enough where they can keep the economy rolling without spiking inflation again, or without having to do some crazy quantitative easing or something like that. So, it's going to be a tough job for them in 24, I'll tell you that. Their job's been easy, in my opinion, really last year and this year, to be quite frank. It's just last year, raise rates like crazy. This year, raise rates just a little bit more and kind of keep them flat. Next year, I hope Jay Powell's ready for a busy next year, because that's going to be a year where they're going to have to make some tough decisions on, do they start cutting? And if they do, when do they start cutting? And
Do they have the ability to temper market sentiment with their words? We just were talking to Steve about that. If it were to get out of it, he thinks that they could take 50 basis points off by, I don't know, just even admitting the possibility of a cut at some point in the future. Other people think if it gets totally unmoored, that the Fed's, that the bond market's going to do what it's going to do, no matter what they say, if it gets bad enough.
I guess I'm not as convinced as Steve is, and I respect Steve a great deal, but I'm not as convinced as he is that this was caused by the Fed, or that the Fed could come out and say something and fix it, or that they would want to. I mean, they've been talking about higher for longer. They've been talking about running off their balance sheet even after they're cutting. And so to do something now to change that, it could look panicky. You know, people are out there talking about, are they going to change QT? Why would they do that? Unless there's some sort of market disruption and a serious one. I mean, remember, this is a Fed that hiked through a banking crisis or ruckus, whatever you want to call it, back in March and May. So I think the bar is high here for them to change things. Could the leadership come out and provide more soothing words at some point? I guess that's a possibility, but it risks looking like an overreaction at the same time. So I think they're in a...
Two other big risks for the Fed and why their job is so impossibly hard next year. One, we got a presidential election coming up next year, right? That's a whole situation in itself. And also, if you think about this a little deeper in regards to, if you were to talk about an actual recession, earnings get hit bad, people lose jobs, people don't make as much money, something like that, guess what? We're running big deficits. If you're going to add out an economic weakness on top of that, then you're talking about massive deficits, right? So that's why this Fed job this upcoming year is going to be so importantly, it's not so hard, it's not even funny, because they can't devastate this economy, or what's going to happen with the deficit? It's going to blast higher than ever. And then if they have to do any, let's call it money printing, oh my gosh, is that going to make a bigger mess than ever, right? So, whew.
Very kind of tricky spot right here if this sell-off continues.
Hey, Brenda, what are you telling people to do right now? Where do you see value? Would you be saying go ahead, lock in some of these longer-term returns? Are there areas of the equity market that you think are potentially a bargain if prices continue to drop?
Yeah, well, I certainly think it makes sense to have some exposure to bonds in this environment, even though that has been painful if you've had longer duration bonds. But nevertheless, that makes a lot of sense. On the equity side, I think sticking with high quality companies that don't have a lot of leverage, that have a high probability of having earnings come in at or above expectations, and that have a good, solid story in terms of being able to improve profit margins. There are a handful in large cap tech that meet those qualifications, companies like Amazon and Salesforce, where valuation is still reasonable. Also, if we look in other areas like healthcare, for example, the healthcare sector really has not participated in the market recovery that we've seen transpire this year. So lots of interesting values there. Even the company like Abbott Labs, for example, that has a core business that's really growing nicely. But yet the company is still kind of working through the COVID test kits and how those were such a positive, and we're now overlapping a period of strength on that side. But if you look at the core business, there's still a lot of value to be had there. So I think there are absolutely still opportunities on the equity side. But I think maintaining a diversified portfolio and including some bonds and considering lengthening duration, I think makes a lot of sense in this environment.
Yeah, so to me, the real opportunities in this market are in a lot of these great brand name companies that are trading off 20, 30, 40% this year. A lot of the value stocks, a lot of the dividend payers. You don't usually get many of these stocks cheap very often, right? And many of these stocks are at 5-year lows, 10-year lows, 15-year lows. And so that's, to me, where the biggest opportunity is for this next 3 to 6 months as a buyer, right? And so that's kind of my thought process. As far as big tech, you always got Meta there, you got Amazon there. If you've got a really long-term horizon, you got Tesla there, right? But I don't see that being the biggest opportunities in the market. That was the biggest opportunities last year. It's a different year now. These stocks have performed differently. The business models have done different things. So, that's kind of my opinions and perspectives on all that. I appreciate y'all joining me as always. Thank you so much for being subscribed to the channel now. 35,000 plus subscribers. Make sure you join my Patreon. That is going to be pinned comment down there, and you get access to see the moves I'm going to be making tomorrow and exactly how I scale that portfolio over time. It's at $6,000 now. We're going to scale it to 10K, 25K, 50K, 100K, and just keep rolling with that one over the coming year. So you definitely want to see what I'm up to there. And I also have a tier in there that has a nice course for you guys that can teach you a lot as well. So much love and have a great day.